Suyog Kotecha, who is the Executive Director and Chief Executive Officer of Aarti Industries, joining me now to talk about his results. Suyog, thanks so much for taking the time. I appreciate the time that you've taken. Good morning. First, tell me what has worked and what has not in the quarter gone by, and the outlook for FY26.
Yeah, no, I think Q1 was a tough quarter, relatively tough quarter. I think we went through some major disruptions, including significant corrections in our raw material itself. I think two major raw materials that account for 70% of our purchase went down by almost 15-20%, which meant we had to take a significant amount of inventory valuation loss of roughly 30 odd crores. And the second, the global geopolitics continued to impact sort of shipments, especially export shipments, where Iran-Israel war led to a lot of choking of vessels coming to Kandla port, which led to deferment of some of the shipments from June to July. So I think with those two major reasons, I think Q1 was roughly 19% down quarter on quarter. I think the shipment delay, of course, will get recovered during the quarter two. But now sort of we're dealing with the US dynamic that has again triggered up in the last 3 to 4 days. So overall, a bit soft Q1. I think on the strategic initiative side, we continue to make the progress. So I think the three major levers that we had given in our midterm guidance around cost optimization, operating leverage, and capex-led growth, I think all three are on track. Cost optimization continues to go as per plan. We are expecting to implement most of the initiatives by the end of this financial year. Operating leverage in terms of ramping up volumes from already announced capacities is also happening well.
Before we get to that, I have a couple of specific questions on points that you've just mentioned. So as I understand it, benzene and aniline prices changed dramatically and you have inventories. And so therefore, those inventory issues were a bit of a concern in the first quarter. I'm just wondering, to what point will that be a drag? And where do you see that settling? Point number one. Point number two, are you on track to achieving that guidance of 1,800 crore to 2,200 crore on top line in the next 3 years, as you've stated?
Yeah, so I think on the first one, near term, I think the issue is kind of settled. We've seen kind of bottoming out of pricing for both benzene and aniline over the course of last 30, 45 odd days. So we expect the inventory valuation related issues are sort of behind us. On the second one, I think on our midterm guidance, and I was sort of talking about it, nothing has changed for us to revise that. I think we basically banking on three major areas for that bottom line growth. Cost initiatives are on track, both variable as well as fixed cost. Operating leverages, most of the capacity expansions on the existing product portfolio are already complete. Now it's a matter of ramping up the volumes and doing market development there. In near term, with the US tariffs, we have a bit of a speed bump. So we have to figure out how to diversify away from US market, which used to account for 15 to 20% of our revenue. But we will figure that out over the course of next few quarters. And the third one is a capex-led growth. That's also on track. The greenfield site in Jagadia will go through phase-wise commissioning throughout the next 3 to 4 quarters. Some assets will get commissioned in the second half of this year itself, and remaining part of the block will get commissioned in the next financial year. So I think all three buckets well on track. So we retain our medium-term guidance.
Retaining medium-term guidance, but in the interim, would you say, Suyog, that we're likely to see a couple of soft quarters while you realign? And you've pointed out that you want to reduce dependence on the United States. We all know what is happening there. So one, that, do you anticipate FY26 to be a consolidation year where you are realigning things? And is pricing likely to be a little bit challenging in the near term from that perspective?
So second part of your question, pricing will remain challenging. I think we've been talking about it for a while now, that the global demand supply imbalance will take some time to recover, which will mean pricing and margin recovery will take a decent amount of time to come back to historical levels. The first part of your question in terms of US, we're still frankly watching out where it settles. I think we're not going to take any calls based on what we have seen in last 1-2 weeks time frame in an immediate sort of manner. As I said, we 15 to 20% exposure to US. We have a variety of products that we sell to US, and different products have different implications. Some of them are exempt. Some of them we have a global competition where we have to watch out for a relative tariff disadvantage. and some of them are pure market development efforts where affordability of the customer itself becomes a bit of a question mark with 25% plus unspecified penalty kind of tariffs. So we will evaluate that over the course of next few weeks and sort of realign our market footprint accordingly.
Suyog, I'm sorry to rush you, but we're running out of time. I just want to ask a small clarification on the margins front. Assuming that pricing pressure becomes a challenge, remains a challenge, we saw it drop quite dramatically to sub 12%. Is that likely to be the run rate in the rest of this financial year as well? I'm talking about operating margins.
Yeah, so I think the margin will remain what we saw sort of average of last year, right? So we're talking about 12.5 to 13.5 kind of percentage is what we are tracking at this point in time. So we will try and hit similar sort of margin profile even during this financial year.
Suyog, thanks so much for taking the time. Appreciate the time that you've spent, and I wish you all the best in what is likely to be a challenging FY26.
Thank you.